With the return of Donald Trump to the White House, we're experiencing particularly uncertain times. The most significant wildcard at the moment is US trade policy and the threat of tariffs. I'm Michael Sager. Welcome to the winter edition of Perspectives. In 2025, the US economy continues to look resilient. GDP growth last year was underpinned by the consumer. This year, we think it will broaden out, with investment spending likely to join with the consumer to deliver healthy, trend-like growth. Other developed economies have not yet delivered the GDP growth recovery we've expected. But there are tentative signs that this is changing. In particular, here in Canada, thanks to aggressive policy easing by the Bank of Canada, robust real incomes and housing construction, we see reasons to expect a meaningful recovery in the second half of the year. By contrast, we see a more muted improvement in Europe and remain relatively pessimistic regarding the economic outlook in China. But overall, the global economy will likely deliver decent growth in 2025 with less reliance on the US. Also based upon economic fundamentals, global inflation is likely to continue on its gradual path lower. Putting the pieces together, our fundamental outlook is consistent with higher corporate earnings and another year of positive equity returns. Bonds look attractive too, given the relatively high level of starting yields. They also serve as a source of purposeful portfolio diversification, which is always an attractive feature, particularly in a world like today with heightened uncertainty and a broader range of possible outcomes for the economy and financial markets. Our constructive fundamental view for the global economy assumes an increase in tariffs imposed on US imports from China, as well as tariffs on a limited set of Canadian exports, amongst other countries. At the beginning of February, the validity of this assumption came into question as the US announced far more stringent tariffs on both Canada and Mexico than we had expected. These tariffs were quickly suspended for 1 month, but the situation will likely remain highly uncertain. Tariffs are equivalent to a tax hike. They're negative for growth. This is true for Canada, and because of extensive integration of US and Canadian supply chains, an extended period of punitive US tariffs on Canada and Mexico will likely also inflict economic pain on the US economy, including auto producers and consumers. Tariffs would also likely boost temporarily US inflation. The US dollar is likely to gain further strength. We expect the loonie to remain under pressure, pushing it well below current levels. Because of their adverse economic and political consequences, we expect that a majority of any tariffs on Canadian goods will be short-lived. This means that the negative hit to Canadian and US growth can be limited, and that our constructive fundamental view for the global economy and financial markets could likely remain relatively intact. That said, the policy environment is far less predictable than usual, and a heightened tariff risk will likely remain for the foreseeable future. In this context, staying invested in a well-diversified portfolio focused on long-term outcomes has typically been key to success.